Good morning, traders and investors. My name is Roger Scott, and I'm the senior strategist for Wealth Press. Today is Friday. It is December the 17th. The markets are going to be opening up in about an hour and 40, let's see here. Yeah, about an hour and 45 minutes or so. Just to give you an idea of where we're at right now, the NASDAQ is down hard. Dow's down just about 77 points. S&P's got a little mix because it has about 30-40% of these NASDAQ stocks in them. Actually, no, it doesn't. It only has about 20%, to be specific, of these stocks in it. Because NASDAQ 100 is only 100 stocks and the S&P 500 is 500 stocks. So mathematically, it would be impossible for it to have more. I guess it's a little early here still. Market doesn't open up for another hour and 45 minutes. Give me a break. Anyhow, getting into today's data, I wanted to show you something interesting. I want you to see the heat map. This is the 5-day heat map. Look at the stocks that have been going up. Utilities, consumer staples. You see that? Defensive steel producers, utilities, and cable TV, staffing, banks, financial companies, healthcare, not tech stocks. So this is where the market cap is flowing into. And matter of fact, if you guys look at the number of stocks, this is 90-day breakouts. I wanted to show you stocks that are making 90-day highs right now. Consumer staples, utilities, healthcare. See that? All making 90-day highs. And look at the stocks that are making 90-day highs. Pfizer, Coca-Cola, Cisco. Cisco's a tech stock, but that is a very, very large cap. Consumer staples, brokers, financial stocks. Again, consumer staples, real estate. I'm not seeing a lot of tech stocks. General Mills, that's one of the stocks that I called to rally because it has such dividend yield. Invesco S&P 500 low. So by seeing this, you could see McDonald's, East Chemical. These are Dow stocks. These are blue chip stocks. These are not your Sherwood-Williams. These are all stocks that are making 90-day highs, and I hardly see any tech in here. Consolidated Edison, Kimberly-Clark, Iron Mountain, Campbell Soup. I think you guys are getting the point. Hershey, Sherwood-Williams, Federated Investors. Not a lot of fancy schmancy tech names. So this is what's driving the market. Consumer staples, utilities, and healthcare. That is something that I actually told you guys was going to happen when the Fed announced they were going to start taking action. The bond market is higher overnight. It's up about a basis point. It's up about right here at the open. But as you can see here, we have a clear downtrend, and this looks like a head and two shoulders right here. And this looks like it's going to go down. So I am still bearish in bonds. I am chalking away at what's going on right now to volatility. And I believe this volatility is just going crazy, especially in light of today's quadruple witching. Today we have option expirations for weekly, monthly, quarterly, and then some. Big, big day for the markets. A lot of unpredictability. But here is what you guys need to know. This is the Russell 2000. And the Russell 2000, let me show you a technical chart of the Russell 2000. It is very, very bearish right now. It looks like it's going straight down. But if you look closely, and I showed you guys this yesterday, it looks like momentum levels are going up and price action is going down. To me, this looks like a classic case of reversals waiting to happen. And the reason why I'm so bullish on the Russell is, let me show you something. Look how choppy it's been. It's now hitting the near-term support level. This is like since February. It's been since late January. It's been trading here. Late-term support level. It goes up and down, but it's at the bottom of that range. But here's the cool thing. If you look at momentum levels, the number of stocks trading above the 50-day moving average, it looks like, now this is COVID. These are some really nasty breaks, but if you look at the regular trading action, look at the bottoms. Look at the bottoms. This is a 5-year weekly chart. This is going back to, let's see here, 2018. Let's go further back. This is 2014. This is 2015. This is 2016. Again, even when we break these levels, we don't really go down too much. And again, this is COVID. This is COVID, folks, right here. So this is like panic, bloodbath, sell-off. We're not in that environment at all right now. I mean, not even close. There's no panic right now. So it looks like we're turning right here, as you could see. That's on a monthly basis. Now let's look at it on a weekly basis. Notice on a weekly basis, same thing. We're getting lower to the bottom. And again, these periods are large fear, VIX factors. We're not in a large VIX factor. Right now, if you look at volatility, we're at 21. If you want to see what volatility was like during that period, the COVID period, we were here. So let me show you a perspective. The market broke. Where are we? Where is momentum? The market broke. Where is that put to call? No, I'm losing my mind here. I'm at three different things. Volatility, where is my, here. So let me just go back here. I don't know how I got out of it. Okay, here we go. Sorry, I should put these next to each other so it'll be easier to go through this. So as you could see here, I had that look on my face just now, like who moved my cheese? But as you could see here, unless there's a major volatility spike like this, we typically don't go to these levels. So this is a typical sell-off level. So it looks to me like we're getting very, very close to sell-offs. That's a weekly basis. On a monthly basis, I showed you the same thing. Look at it on a daily basis. Same thing. Let's go to a further daily basis. You could see here, 1, 2, 3. We're getting really, really, really close. And the divergence that we're seeing right here, as I showed you with a lower bottom, see, price is breaking down, right? But momentum levels can't sustain that price level. It's too much for momentum. And typically when you have divergence, that's what happens. That's what happened right here. Let me show you. I'll show you a perfect example of it. So look, price action can't sustain higher, momentum levels can't sustain higher, and we break down. So the point is, momentum levels, when they can't sustain higher highs, when they're going lower, 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 even though this is kind of close by, it looks like it's a breakdown. In this case, momentum levels can't sustain themselves. Where is it again here? Let me just go back here. Momentum levels can't sustain themselves, and we have the divergence. So I think it really feels like we're bottoming out. And if that's the case, and if the Russell starts going up, the market is going to start getting really, really frisky because smaller stocks are more speculative. So I believe that bonds, we're going to have a lot of volatility, but bonds are going to go down. I believe that the S&P is going to move higher and shake out of this. We're still above the 50-day moving average, folks. And the Dow is actually looking really, really good. It's not looking that bad. We're not below the 50-day moving average. We're still bullish. So let's not make too much out of what's going on right now. Let's not panic. In terms of data, we don't have much data today. Most of the data is we're still being driven by the retail sales report and by the FOMC announcement. Now let's talk a little bit about market action. So higher interest rates, surging COVID cases, and tension between Beijing and Washington. Those are the three major bearish factors driving this market right now. And surging COVID cases, I'm a little confused. Is it the O variant or is it the Delta variant? Because the O variant doesn't seem to be doing much damage. U.S. share dropped the day after Federal Reserve said it's preparing to begin raising rates next year to fight inflation. And traders also considered moves by other central banks. Bank of Japan said Friday, that's earlier today, it would reduce some of its pandemic support measures, reducing purchase of corporate bonds to pre-crisis levels after March. So things look like they're starting to get a little bit better. On Thursday, Bank of England became the first central bank to raise interest rates to fight inflation. Finally, the European Central Bank still plans to trim its pandemic stimulus, but not abruptly. I like what they're doing over there. They're taking action faster. Asia, China. Tensions between U.S. and China were in the spotlight after U.S. Congress approved legislative barring all imports from Chinese Xinjiang region unless businesses can prove they were produced without forced labor. That is very, very smart. Tech is causing the market, the breakdown in the market right now. That's what's really waiting on the market. Rising number of Omicron variant COVID infections also casting a shadow. Public health experts have begun urging great precautions and warning of a worsening wave of COVID outbreaks. And that's kind of what's confusing me because honestly, if this O variant isn't going to cause deaths, then it's not going to cause lockdowns. And if it doesn't cause lockdowns, then I'm not really too concerned about it. I mean, think about the Delta variant. Boy, oh boy. So just to give you a review of this week, we closed out some winners. For Overdrive Profit, we got into this stock right here. This is CF Industrial. We got into it on the 14th right here, and we got out of it right here. We made 26.5%. And on Precision Profits and the VIP room, we had Medtronic. It's a short trade that I took, and we got into this trade 12.14, which was right here, and it broke down, and we took a nice, juicy 103.8% profit. And that's for this week. That's the week we just had. Today's Friday. Those are two winners that we had for this week, and I'm looking at a lot more potential trades because of this pullback and volatility on the table. Next week, here are the sectors that I'm watching very, very cautiously and very, very carefully, and this is what you need to know about. Let's look at the major sectors here. So financials look like they could start rocking and rolling. I like this breakout, and remember, financial stocks are in play right now because of higher rates. Energy stocks looks like it's just kind of sitting and drifting. We went higher, but we closed a little lower. Not expecting too much for energy just yet. Healthcare is going crazy. I did not think that was going to happen, but it did happen because of this Omicron variant. But again, I think healthcare is overdone right now. Technology, I think we're going to cool off, and we're going to continue seeing this crazy volatility. This volatility is just nuts. Look at this. So we may continue seeing that over the next few days. Utilities may stay up because markets are defensive. Consumer staples. If you tell me that I didn't warn you about this, then you're just not being honest, because I did. I told you this was going to happen. Industrial stocks, I think, are going to start coming a little higher up. I think consumer discretionary is going to continue putting pressure on the market, as you saw yesterday with us opening at the high and closing at the low or near the low. Keep your eye on tech and consumer discretionary. These are the big question marks right now, and that's where the volatility is. Real estate is looking really, really good. Communication services is looking choppy. And basic materials I like quite a bit right now, especially if tech and consumer discretionary takes a dump. Next week, we're going to have less news on the table. People are going to start getting in more into the holiday spirits, expect less volatility, and I think the market is actually going to start moving in the right direction. I think we're going to see some positivity. I think the bond market is going to give up the ghost and start breaking down. And unless there's some unforeseeable COVID news or there's some unforeseeable news from China, I think we're going to regain composure, but we may see some sector rotation out of consumer discretionary and out of technology. Now, folks, I've got something important for you. The past year of burn notice alerts has brought Joy of the Trade, Jeff Zananeri, and his traders so many opportunities. Some of his readers have even seen winners like 78% on OSTK, 113% on JOE, 126% on Facebook. And here's the best part. It all happened overnight. And that doesn't even include the 4 for 4 winners that he recommended last week. He's on a roll. Jeff is red hot. There's so much to celebrate. Jeff would like to raise a virtual toast to commemorate the success and look forward to 2022 and beyond. Follow the link below. You don't want to miss out. Jeff was handpicked to be in a team of elite traders. Wait till you hear his background story. This guy's the real deal. Click on the link below. Get all the details now. And as always, make sure to like this video. Subscribe to this channel if you're watching on YouTube. Stay ahead of the market. Be the first to be notified when I post my next video. And remember the most important thing. Have an amazing weekend and send me some feedback. Look, the only way I can improve these videos is if I get feedback from you. Send me some feedback. Support@marketgeeks.com. Good, bad, ugly. If I helped you, if I hurt you, I want to know what I could do to make your life better. And have an amazing upcoming holiday weekend. Bye, guys. Take care and stay out of trouble.